Hey, hi. So, it's the everything rally coming. You can see today's market is more or less everything green. If your portfolio is not green, then I guess something is really wrong. You've got to really review and rebalance your portfolio. There's been quite a few important information that happened the last 24 hours. The first was the FOMC meeting where Fed Chair Powell came out and actually talked about increase 0.25% interest rates. And there are two narratives you can actually look into it. He actually did say that there may be more hikes coming in because that will be based on the CPI data and all those important data, and also he also acknowledged the fact that some housing data are laggard information, whereby the interest rates, even though have gone up by 5%, the inventory and the slowdown in the property market takes time to come down, to cool down. So another way of looking at it is the sign of interest rates increase ending is there, because in all the previous FOMC meeting, which is the Fed Powell will come out and he will always give guidance about what they plan to do the next month FOMC meeting or the September month or whatever. But this is the first time he's not giving any guidance. He said that it's going to be data driven, and which is a good sign. We might end at this final 0.25. And so basically I wanted to share with you one more thing is this morning as well, the market data says that the inflation was pretty good. Let me show you. The US economy expanded an annualized 2.4% quarter to on quarter in the second quarter of 2023, higher than 2% in the previous period and way above market expectation of 1.8. So basically it looks like the US economy is not affected by this 5% interest rates. There's no sign of recession, there's no sign of slowdown. But Fed Powell yesterday did mention that the undisputed eventual outcome that will happen, which is why the market actually rallied after quite a dovish FOMC meeting, where he didn't indicate about future interest rates hike. But then he did say that this sustained longer higher for longer rates, right, will sure dampen consumer demand and also will lower employment take-up rates, which of course all this means that economy will slow down, but it hasn't happened as yet. If you look at this morning's GDP growth rates beats market expectations. So, and another possible data that we have to look at is what we call it the break-even inflation. It's the difference between the nominal yield on a fixed rate investment and the real yield on an inflation-linked investment of similar maturity and credit quality. So usually people will look at the 5-year inflation break-even rate to see if the chances of inflation coming back, resurgence of inflation. If you look at it, there's a slight tick up here, but of course we need to be somewhere around at this level, the 3 mean level. Then it will trigger a Fed hike, But if it's hovering around here or tapering down, then it looks like inflation is really over and it's transitory, and the Fed has managed to actually engineer a soft landing. And of course there is a balanced risk out there right now, which is can be either way, but looks more towards engineering of a soft landing is pretty possible. So I'm just going to show you a very interesting video by Walton.
Dow looking now to extend its 13-day winning streak, the longest since 1987. And back then, a gallon of gas cost 90 cents. A gallon of milk cost $2.28. The median home price was $104,000, and the top-grossing movie was one of Andrew's favorites, Beverly Hills Cop 2. You like Beverly Hills Cop 1?
I think 1 was my favorite, possibly one of my favorite movies of all time.
I know, you have said that. You have said that. And for more on the market's longest winning streak in decades and the Fed's latest rate hike, let's bring in Jeremy Siegel, professor of finance with the University of Pennsylvania's Wharton School. And Jeremy, I look forward to speaking with you because I don't think you're ready necessarily to give Jay Powell like a Nobel Prize in economics, but I think you're coming around a little bit. And you've been a big critic of how tight the Fed was and how loose the Fed was. But now you're changing a little with maybe the notion that they could have orchestrated something pretty good here, maybe in spite of themselves, but maybe they're orchestrating a soft landing.
Yeah, Joe, this was the best news conference I heard from Jay Powell in over a year. I mean, he virtually came close to saying there's balanced risks out there. Not quite, still a little bit more on inflation, but he really acknowledged that there were potential downside risks. He became very data dependent. He talked about, which he should be. I know there's a couple of doves in voting members, maybe Austin Goolsbee, maybe Pat Harker, a few others that said, there is some downside. And he seems to now acknowledge it. It really was very, very encouraging. And another reason, and you're right, that I've shifted a bit of my opinion is I'm looking at forward-looking indicators. The money supply has stopped going down. Commodity prices have stopped going down. Housing prices, measured by the Case-Shiller Index and even the federal indexes, have stopped going down. They've turned around and stabilized. So those very high rates that scared me and the market earlier on in the year don't seem to be having as much of a negative effect as I had feared. And that combined with the fact that Powell now is saying, I'm going to look at both sides of the equation, I think is very positive for the markets.
Pretty amazing, Jeremy. And just thinking back on all the conversations we had when you wanted the Fed really to not go any further, I mean, there was a pause. There were small increments, not 75 basis points anymore. So there was a pretty sharp, certainly the second derivative slowed. And you wanted maybe no more, but they were cognizant of not going too far, doing too much damage. I will tell you one thing that you just nailed, and you've been criticized in the past, Jeremy, for being a perma bull. I don't know how anyone can be criticized when the Dow went from 780 in 1981 to where it is now. Let's see, should I be a perma bull? Maybe that's a good way to be. But you've been criticized for that, but you nailed the October lows. You said this is a new bull market, we're going higher, it's not going back down to test them, and you've been saying that all along.
Yeah, absolutely. I mean, I just didn't see anything that smacked of a recession.
So an academic outperformed all of the highly paid sell-side schmoes on Wall Street, basically.
Yeah. Although I certainly am surprised, at the upside. Again, I thought maybe 15.
So you can see that the market. This guy, Jeremy Siegel, has always been a critic of Jay Powell. And but this time round, he's actually kind of like in agreement with him, saying that actually what he has been doing is actually a grand master plan to engineer a soft landing, and it looks like the intended results are there and looking like it's really, really going to be there for the US economy and the world. So yeah, that's all for today, and hope you like the video, and please subscribe to the channel, and see you soon.